All right, David, I do want to pick it up in terms of something you mentioned, to me prior to the program today. But areas that you and your team are avoiding. You don't hear a lot of people really in the investment industry say they're avoiding certain areas. They don't normally just say they're overweight or neutral. So, what are you specifically avoiding right now?
Right. Well, Catherine, we're very lucky because we have a completely open mandate, which means, we can be anywhere and we can avoid anything. And I think we're in one of those times when there's some big parts of the market we have to be careful of. The biggest part of the US economy is the consumer, and consumer discretionary as a group has been very tricky over the last number of months. Some of the very biggest companies have had a hard time, and it's had a big impact on the indices. And of course, the elephant in the room is technology, and they are growth companies. They do grow, but people have paid a very high multiple, and the multiple has expanded over time. And so, what I've found is that the difference in price from where a momentum investor stops buying and where a value investor steps in can be significant. And we know from
Hmm.
the tech wreck between 2000 and 2003, there were some pretty big declines, and people don't want to live through those things. I remember arguing with people about being time to sell Nortel, and they said, well, we can't sell this Nortel. Well, you can make the same argument about an Amazon or an Apple. They're great companies. They
Mm,
just might not be the right stock to own right now. So we're avoiding
yeah. And do you
consumer.
think that?
I,
You
I, I
concerned
do.
about?
I do. And at some point, there will be a bounce. The problem is they continue to be overowned. And in fact, as of a month ago, hedge funds were more concentrated in the top 10 names than they have ever been. And private
Hmm.
investors in general do have faith in those companies. And they're great companies. It just may be they underperform for a long period of time as the multiples come down or they grow into their earnings. So I'm not talking about
Right.
unprofitable tech. That's very tough. But even
Yeah.
large cap tech, which many of them have just broken to new lows, which opens the door to lower prices. The last group that I think
Yep.
we have to be careful of are the communications companies, and you put Google in that camp and so on. A big part of that index, and so those three places are pretty big parts of the market, and I think that you can just be stepped aside from those for now.
Hmm. And what industries? It sounds like energy. You're still going to continue to be long in, but what else do you think is an area that you would want to have ownership in today? What do you feel comfortable owning?
Well, we're all about finding industries or themes where there is a structural backdrop that will go on for a long time that maybe is underappreciated. So when I talk about materials, a tiny piece of the S&P, a bigger piece of the TSX, but clearly there are structural issues. For 15 years there was underinvestment because they were in a bear market. It takes a long time to put new production into play. And yes, a slower economy will have an impact on consumption. But you have EV coming along, which is going to demand a lot of metals, for instance, and battery materials.
Hmm.
China is trying to stimulate. They just announced a giant infrastructure project, set of projects that will use a lot of materials. You got a war going on where there's a lot of materials being consumed. And we have an agricultural shortage globally that means that agricultural materials are going to be important. So
Hmm.
I get it that people get concerned about an economic slowdown, and financial players have moved away from these groups, even though they were underowned to begin with. But if you look at it today, they still are on a relative basis over the course of this year outperforming, and they may be quick to come back on any sign of strength. And you're
Hmm.
not fighting a group that's overowned by everybody. So I
Right.
think in lots of different markets, you have to recognize there are spots that you can be where the risk reward is pretty good, where the valuations are okay, and there could be a long runway in front of you.
And yeah, that's interesting, because you really don't hear a lot of people talking about owning materials right now. And to your point, you can see it in the lack of ownership, just from a waiting perspective per se. I was actually personally looking at BHP the other week, which almost seems a bit crazy. If you look at the dividend yield, it's telling you that there's a big problem. But I don't know. I don't mind going, long a high dividend paying stock if, of course, it's going to continue to be in business, which you would think BHP would.
Yeah, I mean, there's a whole number of upstream resource companies that are not probably a bad place to be for yield. And if inflation stays sticky, the yields could go higher over time.
Okay, we'll take a quick break. We'll be right back.